What is the market's biggest fear? It is not rising interest rates or economic recession. Those who understand financial history know that the scariest crashes in history were caused by the collapse of the financial system. And this is exactly what is happening right now. On the 10th of March, Silicon Valley Bank, the largest regional bank in the U.S. West Coast, announced its insolvency and closure, causing nearly $200 billion in deposits to be frozen, affecting countless companies and individuals. This event has caused widespread panic in the entire San Francisco Bay Area, affecting large companies like Shopify, Pinterest, and various VC venture capitalists, as well as thousands of startups and residents. This is not an isolated incident, as other financial institutions, such as Blackstone Inc., the world's largest alternative investment fund, was defaulted, and Silvergate Bank has also recently declared bankruptcy. These events are not coincidental, and a financial storm is quietly brewing. For more than a decade, we have become accustomed to this ultra-low interest rate environment. However, there have been warnings that sudden aggressive interest rate hikes by the U.S. Federal Reserve could trigger a crisis in some unexpected corner of the global financial system. And now SVB's collapse became the unexpected focal point of this crisis. In this video, I will analyze in depth the recent SVB scandal, which refers to the Silicon Valley Bank's failure. SVB was founded in 1983, and it is a bank that specializes in serving technology startups in Silicon Valley. According to its website, half of the startup companies supported by venture capital firms in the U.S. are SVB's clients, mainly in the technology and medical sectors, including well-known companies such as Shopify, Pinterest, and CrowdStrike. SVB has been steadily growing for the past 40 years, weathering both the dot-com bubble and the financial crisis. However, in 2020, after the outbreak of the pandemic, the U.S. Federal Reserve implemented massive quantitative easing, flooding the entire U.S. financial industry with excess liquidity. When there is an abundance of money, where do you think it will go? It flows into these startup companies, and SVB was one of the direct beneficiaries of the startup boom because these startups are the clients of SVB. Due to the excess liquidity in the past 2 years, most of the money raised by startup companies flowed into Silicon Valley, and SVB held the largest share. Before the pandemic, SVB's deposits had been steadily increasing. However, in 2020, there was a sudden explosive increase of nearly 4 times. For a bank, an increase in deposits is the most desirable outcome. However, how to manage these deposits became a problem for SVB. To understand how banks operate, banking is arguably one of the most complex industries in the world. We can simplify it by saying that banks essentially do 2 things. First, they attract deposits from depositors, and second, they utilize the deposits to make money for the bank. The bank can utilize the deposits by lending them out, such as by offering mortgages, car loans, credit card loans, etc., or by investing them in stable assets such as bonds. SVB chose the latter by investing heavily in bonds. After the pandemic, SVB's holdings of long-term bonds increased nearly 6-fold, and more than 60% of its $140 billion in deposits were used to buy long-term bonds. This created a fatal risk for the bank. Why do I say that? Many people may think that bonds are one of the most stable investments, especially U.S. government bonds. But actually, this is a misconception. Here, I need to give you some knowledge about bonds. Bonds earn money through 2 parts: interest income and the face value of the bond. The interest income is fixed from the moment you invest, and you will receive the same fixed interest every month thereafter. The face value of the bond, on the other hand, will fluctuate due to market interest rates. Therefore, the main profit or loss of buying bonds actually depends on the fluctuation of the face value. Understanding this issue will help you understand why SVB is facing such a great crisis. In fact, the face value of bonds is inversely proportional to the interest rates set by the Federal Reserve. When interest rates rise, the price of bonds will fall, and vice versa. Normally, In a policy of gradual interest rate hikes and cuts, the face value of bonds will not fluctuate too much. But last year was different. The Federal Reserve can be said to have opened an unprecedented crazy interest rate hike mode, and correspondingly, bonds had their worst performance in the past 250 years of U.S. history with recorded history. Moreover, the longer the term of the bond, the more sensitive it is to changes in interest rates, and the worse its performance. So, long-term bonds have become one of the biggest victims in this interest rate hike cycle. And this is precisely the type of bonds that SVB holds in large quantities. As the chart shown below, we can see that among the company's assets, all the bonds classified as held to maturity have suffered huge losses, with an average drop of 16.6% and a total unrealized loss of $15.2 billion. If we add in losses from other types of bonds, the total unrealized loss reaches $17.5 billion. Is this the real reason why SVB closed down? It's not, this is just a trigger. It is important to note that the term used above is unrealized losses. Seasoned investors know the adage. Unrealized losses are not losses. In fact, it is quite normal for banks to have some unrealized losses on their balance sheet, especially for bond investments. As long as the bonds are held to maturity, these unrealized losses will automatically disappear. Even if the bank does not hold the bonds to maturity, it is widely understood that the Federal Reserve will not keep interest rates this high forever and will eventually lower them. Once interest rates decline, the face value of the bonds will rise again, and these unrealized losses will be gradually offset. However, this time an unexpected change completely disrupted SVB's calculations. The unexpected event was the collective downturn of Silicon Valley's tech startups. As we know, SVB's main clients are these Silicon Valley startups. During the liquidity glut of 2020, they provided unprecedented opportunities for SVB. But after the liquidity tightened in 2022, the tech startups were hit hard, with many struggling to secure financing and some forced to delay their IPOs. Some high-risk startups were the first to buckle under the pressure. Moreover, the economic environment for these tech startups last year was extremely challenging, with many cutting costs and reducing headcounts, a trend that was amplified among smaller startups. This has caused the Silicon Valley startups to have to use up a large amount of their deposits to survive, gradually consuming the deposits that SVB relies on for its own survival. Moreover, due to the rapid rate hikes by the Federal Reserve, the risk-free rate on short-term Treasury bonds is now approaching 5%, while the interest on bank deposits is still below 2%. For businesses, they generally have professional financial managers to manage their assets, who are more sensitive to the financial market. Therefore, in order to better manage cash, many companies simply withdraw their deposits and invest in higher-yielding and risk-free U.S. Treasuries. As a result, it is these startups that are facing huge financial pressure that have caused a large amount of deposits to be forcibly withdrawn from SVB. From the chart, we can see that SVB's deposits have plummeted sharply since 2022, falling by $25 billion from the peak. For SVB, this is a very large amount because the bank's market value was only $16 billion at the end of 2022. Such a large-scale loss of deposits has forced SVB to sell assets to supply customer withdrawals. These so-called unrealized losses can only be called unrealized losses when the assets are still in hand. When the assets are sold, these unrealized losses gradually become realized losses. And when the realized losses continue to expand to the point where the bank can no longer support them, a real crisis will occur. SVB, in desperation, decided to make a final attempt to survive. The company announced that it would sell $21 billion of its bonds, incurring $1.8 billion in losses as a result. Unfortunately, even this amount is not enough to fill the gaping hole in their finances. The company also announced plans to issue new stocks and preferred shares to raise more funds. They know that they can no longer sell their assets, as the $17.5 billion of unrealized losses on their books is too much for a company with a market capitalization of only $16 billion to bear. With no other options left, they turned to public financing and hoped that someone would help them weather this crisis. Unfortunately, their attempts failed, and after the announcement, the market reacted swiftly. Within a day, SVB's stock price plummeted by 60%. Investors all know that the last time a big bank claimed to have no money was Lehman Brothers during the 2008 financial crisis. It was Lehman Brothers' bankruptcy that ultimately led to the most severe stock market crash in the past century. Following that, the entire startup circle was also in chaos. In the face of the crisis, no one was willing to help them, and everyone was thinking about how to protect themselves. One of the founders of Founders Fund, Peter Thiel, who is known as the father of entrepreneurs, was the first to urge his clients to withdraw money from SVB. Following that, major VCs such as Coatue Management and Union Square Venture also called on everyone to switch banks. Soon, all depositors became anxious, and the classic scene in banking history appeared: a run on the bank. My friend who is an entrepreneur in the Bay Area told me that as soon as he saw the news on social media, he quickly transferred all of his money from SVB using online banking. Just 10 minutes after he transferred his money, SVB stopped all bank transfer services. Yes, this is the ultimate outcome of a bank run. Under extreme panic from everyone, the bank closes its doors and depositors can no longer withdraw their savings. This classic scene in banking history did not take long to happen. The day after the news was released, which was Friday, SVB was forced to close its doors due to the bank run, and its stock price plummeted by another 60%. The company said they were seeking buyers to take over, but no one was interested. In the end, SVB was taken over by the government that afternoon. Now that we investors have a general understanding of the story, let's explore the fundamental reasons behind this event. Is it a natural disaster or man-made calamity? And will it spread to other banks? In my opinion, there are three main reasons for this bank's collapse. First, SVB's clients were too concentrated and overly dependent on funding from the tech startup industry. Once this industry encountered problems, SVB did not have effective risk management measures and could only sink with its clients. The financial pressure faced by these startups was greatly amplified on SVB. A similar situation also occurred with another recently bankrupt bank, Silvergate, which was too focused on the digital currency industry. The situation in the crypto industry is also worrisome, as the collapse of FTX and Three Arrows Capital. Banks that serve this industry also cannot sustain themselves and declare bankruptcy. Second, SVB's own asset management had problems. Perhaps it was because they had never managed such a large amount of assets before. Their actions in 2020 after receiving a large amount of deposits were puzzling. Long-term bond exposure carries extremely high interest rate risk, which a professional financial institution like SVB cannot ignore. However, they still invested nearly 60% of their assets in long-term bonds. What is this concept? Among 74 other banks in the United States, no company comes close to Silicon Valley Bank's SVB. The bank with the second highest proportion of long-term bonds has only a 42% share. However, in the banking sector, risk control exemplar Morgan holds only 11.6% of total assets in long-term bonds. I believe that SVB's failure is entirely the responsibility of its management due to poor risk management practices. The third and most critical reason is the Federal Reserve's interest rate hike policy, which obviously caused both the losses in SVB's long-term bonds and the financial pressures on startups, and was caused by the Federal Reserve's monetary policy tightening. If we were still in a low-interest rate environment, this situation would not have happened. However, we cannot solely blame the increase of interest rates. SVB's crisis was caused by a combination of poor management, the inherent risks of the business model, and the backdrop of interest rate rises. Any one of these factors alone would not have led to this situation. Now that we understand the underlying reasons for SVB's failure, the most critical question is what kind of subsequent impact it will have. Will it spread to other banks and cause problems for the entire financial system? All major banks are now coming out and saying that SVB is just an exception and will not affect the safety of our financial system. Is this really the case? Before the 2008 financial crisis, major banks were also confident that the subprime mortgage problem would not pose a risk to them. So, can we believe their words this time? To answer this question, we can analyze the scale of the risk exposure. What is the size of the specific risk that banks have exposed themselves to, such as subprime mortgages in 2007 and 2008? Large banks had significant exposure to these risks, and almost all banks had a large number of subprime products. Once the subprime crisis occurred, no one could escape. We also need to look at the specific risks that banks are currently exposed to. When discussing risks, we must be specific and not just say that if the hike rates continues, there will definitely be another crisis. This logic is not objective. We need to look at the direct risk exposure and see how big it is and whether it can be replicated. In fact, there are two factors that directly led to this crisis. One is the high proportion of long-term bonds that are sensitive to interest rates, which caused the bank's asset losses to be too large. The other is the financial pressure on the target customers, which led to significant outflows of deposits. Regarding the first point, we have already mentioned that most banks do not have such high risk exposure to long-term bonds, and this is more of an issue with SVB's own fund management. As for the second point, most major banks do not have this concern. The following chart shows the changes in American savings rates over the past year. It can be seen that the overall savings rate of Americans has not only not decreased, but has also been steadily increasing. This indicates that the risk of deposit outflows is not a general trend, but only appears as a local problem. Additionally, most of the major banks' clients are relatively diversified, not like SVB. It can be seen that the current major banks' risk exposure is relatively low, even in the event of specific issues in certain areas. The risk is completely controllable from the perspective of the entire financial system. However, although most banks are relatively safe, there are two exceptions that investors must try to avoid as much as possible. The first is those banks that specialize in serving a particular industry. The risks associated with this business model are difficult for banks to control themselves. Currently, the highest risk is with banks that are heavily tied to real estate. In the context of the current situation, real estate is also one of the hardest hit industries. Companies currently in the spotlight include Signature Bank, which primarily provides loans for commercial real estate, and First Republic Bank, which provides financial services primarily for real estate companies. The second high-risk area is the local banks in the Bay Area. They may also have some risk exposure that needs to be resolved because SVB may have business connections with other local banks. Therefore, SVB's failure may affect these banks as well. In addition, the liquidity of local startup companies in the Bay Area has dried up. This risk will not only affect SVB, but other banks may also be exposed to similar risks. Whether you are an investor, a local business owner, or a resident, I think this risk needs special consideration. In my opinion, this financial crisis is a tragedy caused by both natural disasters and human error. In the context of interest rate hikes, it is obvious that all companies are having a hard time. But without the incompetence of the SVB management, and the risks exposed in its special business model, this crisis would not have happened. So I think its impact on the financial system is still relatively controllable. I also do not think it will affect other banks' normal deposits and loans. Thanks for watching. What do you think about SVB? Leave it in the comment.